Hi everybody, it's Clarke Camper with the July edition of Wall Street and Washington. Today I'd like to cover three things. First, I'd like to talk about some good news and some not so good news relating to the federal fiscal cliff. Second, I'd like to talk about some less noticed other governmental actions that could threaten fiscal stability. And third, I'd like to talk about some significant regulatory developments at the SEC and the CFTC. First, in terms of the fiscal cliff, there's a lot of good news around it. There's been a ton of attention paid to the issue and the potential impact of the fiscal cliff on the economy. You've got everybody from members of Congress, Wall Street analysts, business groups, Ben Bernanke, all weighing in and saying that Congress and the president need to do something to avert the fiscal cliff. That's all great. However, the less good news is that perversely within the Beltway in Washington, the impact of that has been actually that the issue has become much more politicized. So all the attention on the issue has politicized the issue and frankly caused the two parties to begin laying down their demands around the issue that in turn make it, I believe, less likely that we actually will avert the fiscal cliff. Specifically, Democrats have started to say that taxes must be raised on the more affluent if they are to agree to any package that averts the fiscal cliff. On the flip side, Republicans are saying absolutely not, you may not raise taxes. Again, the bottom line is that it's making it less likely that we actually come to an agreement to avert the fiscal cliff. I want to be clear, as I've said all along, I personally believe that Congress is going to address the fiscal cliff. I don't think it'll happen in a very sophisticated or comprehensive way. I do think they'll kick the can down the road, but importantly, I think they'll avert the cliff. However, this political development makes me less certain in that prediction. Moving on to my second topic, other governmental actions that could threaten fiscal stability. The first such action occurs at the end of the federal fiscal year, which is the end of September. And what could happen there is an actual governmental shutdown. How do we get there? Well, Congress, which has been typical in recent years, so far has not enacted the spending bills that have to be enacted to enable the government to continue spending into the new year. What's happened typically is that Congress agrees to some sort of a short-term extension to keep the government funded at current levels, and we move on until they can retroactively go back and address the new budget year. The difference is, in this political year, there are some Republicans, particularly House Republicans, and particularly some freshman members of the House caucus, who are looking at the situation saying, look, this is our one time to actually begin to really cut spending. And so they are advocating not for a continuation, as usually happens, but actually for a new approach which would cut spending going into the new year. That, as you can imagine, would be quite controversial. If that were to play on out, we likely would face a governmental shutdown. Now, personally, I don't believe we're going to face that. I think that House leaders feel that it would be very damaging to Republicans to go into the election season having shut down the government, but I do think it's important for viewers to know that that possibility exists. The other fiscal activity, or the other governmental activity that threatens fiscal stability, though, I do think is more threatening, and that is the debt ceiling. Remember what happened last summer, with the debt ceiling debacle? Well, we are facing again, the next time that we need to raise the debt ceiling is likely early next year. And by all accounts, the way that we're running up to that event, it looks like we're facing a repeat of what happened last summer. Now, it's far too early to predict with any more specificity what might happen. I hope that that's not the case, but it is not too early to at least spot that and say that right now it's looking like that could be another drag down, which would have likely very negative impacts on the economy. Finally, I want to close by commenting on a couple significant developments regulatorily, both at the SEC and CFTC. Most importantly, the SEC finalized its Consolidated Audit Trail, or CAT. They made some significant changes from the CAT as proposed. For instance, the audit trail is not real-time, which makes many in the industry happy. One very important, though significant change is that the CAT now is, under the finalized CAT, the SEC is directing SROs and FINRA to go away and collectively come up with a way to implement the CAT. In other words, the CAT itself at the SEC level is much less prescriptive than it had been previously. Now it's interesting, the SROs and FINRA are supposed to come back to the SEC by May next year, so May 2013. What I find interesting is that many observers are saying that actually, while that sounds like a lot of time, that in fact it's going to be extremely challenging to accomplish that task. When you get various SROs, when you get FINRA, when you get dealers, when you get all the market participants involved, there's so many varying points of view, so many varying stakeholders, that it could in fact again be very, very difficult to meet that deadline of a single unified industry suggestion back to the SEC in May. And think about the fact on top of that, that obviously May is after the presidential election, so it's not possible with any certainty now to say who's going to be heading the SEC at that point. So that all adds up to the fact that significant progress on the CAT, but watch this space because it's going to continue to evolve. Finally, I want to close by saying a few words about the CFTC. They reached a significant regulatory milestone recently when they finalized the definition, some key product definitions, most importantly the definition of a swap. What that means is that all the rules, or many of the rules that the CFTC has already finalized, now can move forward. Now that they've actually finalized the definition and can drop that into the rule. For instance, in the fall then, this means that major swap participants and swap dealers will be required to register with the CFTC, and I think, as I've talked about in previous editions of Wall Street and Washington, I think this puts the CFTC very much in place to actually implement some of the clearing requirements of Dodd-Frank by the end of 2012 and have the rest of the derivatives requirements in place in 2013. So with that, I'll wrap things up and we'll see you next month on Wall Street and Washington.